So now let's move on to preferred stock, aka equity. But it's also considered a kind of bond. As in, if the equity pays dividends, then technically it's recurring payments, kind of like a coupon. But there's a difference because equity, unlike bonds, even if you don't pay them off, you don't risk bankruptcy. You don't risk defaulting because it's different. Dividends are owed and instead accumulate and can be paid later. So let's look at the difference between preferred versus common stockholders. So preferred stockholders are paid first in dividends, and common stockholders are then later paid. However, overall, if a company is bankrupt, bondholders get the first priority, followed by preferred and then common. Because bondholders are considered debt, the other two are equity. So next is fixed versus floating preferred stock. So preferred stock pays a fixed dividend. So it is considered a perpetuity because it's fixed cash flows provided indefinitely. However, in contrast, floating rate preferred stock is much like a floating rate bond, where dividend rates are linked to a measure of current market interest rates. So the floating will be adjusted at regular intervals. Could be yearly, they look at a market interest rate and then adjust the payments given as dividends. So some important key things to note. Interest payments on bonds are tax-deductible expenses. This is the tax implications. Dividends paid out on preferred stock are not tax exempt. However, 50% of dividends received on preferred stock are tax exempt for companies. As in, if a company was to invest and be paid in dividends, then they get 50% tax exempt dividends. But this is only for companies. I do not think it's the same for people or individual investors. So yeah, once again, interest payments on bonds are tax-deductible expenses, so interest payments from bonds are very desirable. Dividends paid out on preferred stock that we have to pay out, they're not tax-exempt, but as a company, payout doesn't tax-exempt us. However, receiving will let 50% dividends be tax-exempt. But it has to specifically also be preferred stock. So let's look at an example. If a firm's tax bracket is 21% and it receives $10,000 in preferred dividend payments, then it pays tax for just half of that income. So they receive $10,000 preferred dividends, and so 50% times 10,000 is 5,000, and then times 0.21 tax equals 1050 tax, right? So the actual effective tax rate on the 10,000 dividend is just 21% of tax times 50% equals 10.5%. That's what we were actually taxed. We were only taxed half of the 21%. Or we could also calculate this simply with $1,050 tax divided by 10,000 equals 10.5%, or 0.105. So because of the tax exemptions or other reasons, most preferred stock equity is usually held by corporations. Preferred stock rarely gives its holders voting rights, but it can give them voting rights if a dividend is skipped, as in if they miss the payments on dividends, so they can grant them some voting rights.